Well, hello, everybody. This is the latest of the monthly NIPE events, and this one is on the topic of the evolving world of crypto. I'm Ron Mazurski, the founder, board member, and officer at NIPE, and a partner with Pagility Advisors. We've been holding these monthly NIPE panels and networking sessions since the pandemic began back in March 2020. We run these panels for 1 hour, followed by a 30-minute networking session. And each of those networking sessions are probably going to be somewhere between 5 and 7 people per group. Before March of 2020, we were holding the panels about 5 or 6 times a year in person. And most recently, those were hosted in the offices of our annual sponsor, Davis Wright and Tremaine. We'd like to thank Davis Wright and Tremaine for helping to support us financially along the way, and we look forward to returning to in-person meetings later this year. I want to let everyone know that later next week, we'll be sending out a member topic survey and asking each of you to complete this 5-minute survey. We are looking to understand your interest in specific event topics. We're going to be providing you with a list of 10 different ideas and asking you to rank those for us, at least the top 3, so that we have an understanding of which areas are of most interest, and we'll use those to plan sessions for the remainder of the year. Before we begin our panel today, I want to ask if any of you have any questions for the panelists. Please type them into the chat feature on the bottom of your screen, and we'll be using the chat feature to ask you guys, to ask the panelists to respond as appropriate. At this point, I do want to ask everyone to please turn off your video camera and make sure that you're on mute as well. That way, only the speakers are going to be visible and no other noise will be presented to us. At this point, I do want to introduce you to Tim Sloane. Tim is the VP of Innovation at Mercator Advisory Group. He's the guy with the mustache, by the way, not the mustache and beard, just the mustache. And Tim, let me give it to you, and thank you for leading the session today.
Absolutely, my pleasure, Ron. And it's wonderful to be here with such a learned group of panelists. It's not often you get this kind of knowledge about crypto all together in one group, so it's an honor to be here. My background at Mercator Advisory Group around crypto has been, we've been advising financial institutions and processors around the block and tackling associated with custodial services so that the banks can buy, hold, sell crypto and connect that crypto to their card accounts to be able to drive some profitability for them through that connection. The recent executive order has driven an amazing amount of discussion around central bank digital currencies. We had a fascinating discussion with the Federal Reserve Bank in Boston and around the Hamilton project, and the politics associated with moving to a central bank digital currency is huge. Unlikely to be resolved soon. A lot of legislation needs to be resolved. Let me say that I think the magnitude of crypto is presented perhaps by the state of crypto. There's 18,000 different cryptos out there, only a few of which have any significant volume. And 16 different wallets that can access that crypto. Bitcoin market value is about 780 billion as of today, I believe, and Ethereum is about 332 billion. And those platforms represent the hub that are generating numerous new types of financial services and capabilities that are coming into the market and disrupting the market. And so it's a very exciting time, and we've got the panel to be able to talk about it. I think let's start off, Ram, if we could, with you kind of giving us the lay of the land around some of the technology and the terms being used within this environment, and of course, introduce yourself.
Sure, I'll be brief in the intro. First off, that's a great framing. Thank you, Tim. I'm Ram Alawali. I lead the digital assets and crypto business for Cross River. Cross River is a B2B2C digital infrastructure bank. We power leading crypto players, including Coinbase, eToro, and others. And really pleased to share that Cross River is the first bank to receive non-objection for the FDIC to offer crypto custody, crypto collateralized lending, and the ability to enable the buy, sell, and trading of crypto via API. So really, really exciting time here. To look at the category, you have crypto assets outstanding around, call it $2 to $3 trillion in value, depending on the day of the week and the volatility. And it's very easy to simplify crypto and just look at it from an asset perspective. But the reality is underneath that headline number, there are a number of rapidly growing subcategories. I'll walk through those briefly and define them. So one is stablecoins, and stablecoins are a digital dollar on chain. It's a token that corresponds to some cash in a bank somewhere. And of course, stablecoins can also be linked to gold or other forms of currency, other kinds of assets. And stablecoins have now enabled something like $1.8 trillion in transactions over the last year or so, and there's over, call it 100 billion or so outstanding. That's one category. Presents a new payment rail that's 24/7 and creates a substantial risk for Visa, MasterCard, and traditional payment rails for various reasons we can get into later. Another category, of course, is DeFi lending, where the total value locked, in other words, not loans outstanding, is about $150 billion. And to put that in perspective, if you take the leading fintech lenders, SoFi, Upgrade, Marlette, Upstart, so on and so forth, you can multiply their loans outstanding by 5, and it would still probably be less than the amount of DeFi loans outstanding, where you as an individual consumer could earn anywhere from 2% upwards of 20% through fully secured loans on chain or staking. And there are other categories as well, crypto blockchain gaming, where you have the emergence of these economies where you can buy assets such as avatars, tokens, like and other artifacts like a battle axe or join a guild through a virtual currency. Axie Infinity is an example of this. That's received a lot of adoption in the Philippines, so much so that the Philippines version of Craigslist denominates some of their goods and services in the unit of account in Axie Infinity. Some other categories include the metaverse, as well as DAOs. So it's a very broad category. It's growing rapidly, and excited to dig into more of this.
Boy, I sure hope everybody's following, because it's going to get more complex from there, perhaps. But we will dive down into the individual aspects of this to try to simplify and share thoughts about where it's impacting existing financial services. So maybe, Dominic, you could give us a little sense of the investor community and how they're thinking about the crypto space in general and where they're placing their bets. And of course, introduce yourself as well.
Sure. My name is Dominic Ward. I run Iconic US. Iconic US is the subsidiary of a German crypto asset manager called Iconic Holding. In Europe, we are more focused on crypto-focused index funds, and we have a Bitcoin exchange traded note. Here in the States, we're more focused on crypto VC and crypto hedge fund. So your question as far as investors is really right up our alley. We engage a lot of people on what they're interested in and why. I'd say up until this year, most of the interactions we had were with medium-sized family offices. These are people who either had their feet wet in crypto through a very simple product, maybe like one of the Grayscale Trust products that were out there, or they had no crypto exposure at all and felt like they should have some. And oftentimes these people will come to crypto events or they'll reach out to us. And basically we are almost like a teacher. Those things rarely lead to us receiving investment dollars. But if you're an investor in this space and you have been for the last 3 to 5 years, you probably spent a lot of your time teaching. And that's part of what we do. So I'd say up until this year, most of who we interacted with was medium-sized family offices. This year, large financial institutions have called us and they've reached out to us, not the other way around, and said, tell us what you can tell us about the environment. And I know of one place with $80 billion in alternatives that has gone out and spoken to something like 36 crypto portfolio managers to get the lay of the land. So very, very quickly, we've shifted in scale from the types of investors who reach out to us and try to educate themselves on the market. In my sense, for the bigger institutions is, in some cases, I think they have younger members of the team who are true believers who've been pushing internally for the firm to allocate. And in other cases, I've heard from senior people that they've been told this is the year they're going to allocate, whether they believe in it or not. So they better just find the best teams to invest with or invest in. There will be an allocation to this space this year. So I'd say the types of investors who we're seeing are changing. I'd say also occasionally, this is not steady, we hear from a mid-sized public company that says, I have $500 million in cash. I'd like to invest some of that in Bitcoin. How do we do that? Can we buy it from you? But that only happens when Bitcoin's running really hot and they feel like they missed the boat. That is not a steady stream of investment capital that we see. Whereas the other two groups I've mentioned, they seem like they're here to stay.
So that's where the investments are coming from. Are there, you're the one putting the dollar down on the bet, so it's a real bet. Are those bets in particular areas of crypto, or are they really, as you mentioned, based on the team and whether that team has a great business plan and can pull it off?
Well, I'll say we have decided not to silo ourselves, which is a conversation we've had multiple times over the years. We basically just invest in the best teams we can find, full stop.
Okay.
Especially in the early days, there was a lot of junk out there. That said, even people here on this call who are not crypto people are familiar with the fads. They've heard of NFTs. They probably have started hearing about DAOs. So there are these waves where we see a lot of money going into, maybe fad is not fair, but I just said it. So into some of the more faddish parts of the industry. Before all that, though, I think the smartest bet, and maybe still the smartest bet, has been in infrastructure. Like the pipes and plumbing that make all of this work has really been the place to be. That was true when we started this business. It's honestly still true today. I think there's still lots of room for pipes and plumbing investments in the NFT space, for example. So that's an area where I think you'll see still a lot of money flowing, not just here in the States, but internationally.
So I've had a long held problem with the existing NFTs in the marketplace. Lack of provenance, lack of identity. I believe in NFTs in a big way. I think they could really be valuable and change markets. Just the execution is kind of iffy, and the lack of regulations to force them to become better at it is difficult, which I guess kind of takes us to Alex. So Alex, if you could give us a high level sense of the regulatory constructs and legal constructs around all of this and introduce yourself, I think that would maybe get us started.
Yeah, thank you so much, Tim. And first, I just want to say on behalf of my firm, we're glad to continue supporting NIPAY, and I'm certainly glad to contribute here. I am a partner at Davis Wright. I've been at the firm for almost 4 months, and I lead our digital assets crypto working group as well as our fintech women group. So I'm very honored to have those leadership responsibilities. I think it's a very exciting time, whether you're an investor or you're at a bank or you're providing legal advice, to be thinking about crypto, because we are really, in many respects, as a country at an inflection point where we've got this tremendous growth in digital assets, but we have a largely unregulated, from a federal perspective, a largely unregulated framework. And so the way I kind of approach a lot of these questions around opportunities and risk is from a balanced perspective. I spent about 7.5 years at the FDIC prior to my role here at Davis Wright, and that was a very risk-focused discussion. And now, having left and being back in private practice, I'm getting to engage more with the innovators and really learning about the promise of crypto. And so I like to think about the healthy balance of those two things, risk and innovation. And so, you know, when we talk about sort of the different buckets of crypto or the different types of digital assets, it's really hard to say, oh, here's all the different regulations that apply, because it's so multidimensional. In fact, if any of you are familiar with the executive order that President Biden issued and signed last week, you'll already know that there are upwards of 20 different federal entities tasked with doing different kinds of reports, all on digital assets, which spans, you know, as Ram talked about, stablecoins, as you mentioned, NFTs, cryptocurrencies, central bank digital currencies. So those are all the kinds of crypto in the broader bucket. And then within each one of those segments, you've got national security issues, financial stability issues, you've got safety and soundness issues, you've got literally like a laundry list of cross-cutting issues across a very large universe of digital assets. And you're sort of left thinking, how is this all going to get regulated? How are all these governmental entities going to do their reporting, and will we have something that is actually usable? It's the risk of, you know, potentially having a lot of cooks in the kitchen and no one kind of overseeing it. So, you know, I think as a lawyer, as I see the regulatory framework hopefully evolve, I'm excited to see that the executive order says some positive things about crypto. That is not something that I think we've seen before publicly, certainly not from the White House. So it's definitely gotten a lot of attention, and from the very top. And so that's how I would kind of address sort of where we are from a broader regulatory framework.
Yeah, it opens the door to lobbying at this point to try to get all of those regulatory agencies in line with what we're trying to accomplish. The line that caught me was in the EO was systemic risk, which was the flag for Dodd-Frank and really major changes within the financial community. And I suspect we're probably looking at very similar kinds of substantial changes. We just don't know what they're going to be yet. It's getting to be crazy. At this point, would you say you've seen any winners or losers just in the environment as it exists, where they've been able to work within the limited regulatory framework and be able to grow? Certainly, Ram has managed to move his products into the custodial world and be able to start finding financial institutions, which I've seen as well. They're all looking for a way to participate within this in a safe, sound, regulated kind of way. You see them connecting to Visa, MasterCard, becoming, was it Coinbase became a part of what's the term, registered participant within the Visa network. So, you know, it's really moving towards significant volume and support within crypto. Are there particular market segments you've seen that are moving it?
Well, I think I would echo something Dominic mentioned earlier. To me, the winners in all of this are going to be those that have the most important, well-informed, varied perspectives on crypto, those who are educated, those who go to the CLEs or just educate themselves. To me, in order to think about any of this, you have to understand the facts on the ground and the innovations and the risks. So at sort of the next level, it seems to me that if the regulators are following a path of same business, same risk, same kind of regulation, that crypto companies outside of banking, outside of bank examination and bank supervision and bank regulations, the regulators are going to look at them and say, you're facilitating payments, you're custodying assets in some cases, you're doing what they view as and what are bank-like activities. And so the key challenge and interesting issue in all of this is the extent to which companies outside of that, bank regulatory perimeter might in the future find themselves within it if they want to continue doing those kinds of bank-like services. We've seen hints of that in some federal reporting. We've also seen hints of that in some proposed legislation from the House side. And so to me, the winners, you could say, are the incumbent banks who are effectively already being supervised and innovating themselves. I mean, they're there are groups of banks today that are in a beta phase and minting stablecoins with the ultimate goal of providing stablecoins to their retail customers. They're doing that. They're engaging with their regulators. They're kind of operating thoughtfully. They're not, there's not a clear guardrail for them, but they're public and they're engaging their regulators as they should be. I think the entities that are not going to be as successful, you can call them losers, but I'll call them not winners, are going to be those entities that aren't
you are
innovative.
in politics, aren't you?
I am. I'm in DC. I'm in the Beltway. But anyway, they're going to be the entities that are just doing the same thing as they've done for the past several decades. They're not investing in the cloud. Maybe they don't have the resources to invest in the cloud.
Yeah.
And some of them look for merger partners because they just don't have those capabilities. But at the end of the day, if you're not at least thinking strategically about your crypto plan, if you're a bank, even if you're a community bank, then I think you're going to be left behind. And I think there are FDIC reports. There's a report that came out in February, which I often talk about. And essentially, the takeaway from that report is, we looked at PPP, we looked at the conduits for PPP, and it was those banks that invested in the infrastructure that were able to leverage a lot of that relationship for their broader business strategies to grow. I mean, so even the regulators, maybe not directly, but they are noticing these kinds of trends across the banks that they supervise, and seeing the benefits of a strategic plan that in some way encompasses innovation, and that may or may not involve crypto. The other thing I do want to say, the OCC has put out interpretive letters on crypto custody. That came out around Thanksgiving last year, and many people were quite grateful for the timing of that. So I don't want to leave you thinking that the federal government hasn't done anything. Certainly across the federal banking agencies, I think in my view, the OCC has been a real leader in terms of thinking about crypto and speaking about crypto publicly through the acting comptroller, Mike Sue. So we have seen efforts at really trying to address risk and innovation, but clearly, I would say the U.S. needs to catch up. And so I think that's what the EO really does, hopefully.
So
I can chime in on
So
winners and
Yeah,
losers.
just from a practical perspective, if people want to look at the stock charts, for example, of Silvergate Bank and Signature Bank, those are two groups I think you could look at as winners thus far that were not enormous global banks, but decided to embrace crypto and build strategies around it to grow their crypto deposits. And I think if you look at the valuations, you'd say today, yeah, it shows. So I'll just throw that out there.
I'd agree. And I like the way you framed that up, Alex, is, our view is that regulators are making banks the de jure control layer for crypto. Why? Because they have a compliance framework, because they require KYC, AML, sanctions enforcement, and screening. So tech-forward banks that can win the confidence of the regulators should do well. However, there are many losers, and this is what makes crypto so dynamic. For example, if you're a money transmitter, which is how Coinbase is regulated today and many other crypto exchanges, it's not clear that you have the authority to even perform custody or enabling the buying, selling, and trading of allegedly or arguably are securities. And so you're seeing, for example, the $100 million settlement BlockFi had with the SEC and state AGs, which also limited their ability to conduct certain business, or the class action lawsuit against Coinbase, against our customer. We're rooting for them, that took place today. So there are many losers. Let's walk through some of the loser categories. One is card issuers. So if you're making money through interchange, you swipe your card, transfer at a terminal, you earn 2 to 3 points. That business is ripe for disruption because you can transmit money through crypto with de minimis transaction fees at scale in a decentralized network that's 24/7 without intermediation. That's one. Now, Visa and MasterCard are very thoughtful, and they built crypto teams, and MasterCard bought a company called CipherTrace, and Visa has a thoughtful crypto team. So they get it, they see what's at stake, and they're doing the best they can. But still, that's a challenge for both Visa and MasterCard, as well as the issuing banks, the leading issuing banks and the smaller issuing banks, and the merchant acquirers. Others that are at risk are money transmitters like Western Union. Why do you need to pay 7 points to move money from one country to another if you can do it permissionlessly on chain? You're seeing Coinbase now team up with Remitly to move money between US and Mexico. By the way, Remitly is an interesting example. Remitly is a peer-to-peer international money transmitter that's trying to compete with Western Union. It's a venture-backed company, went public about 6 months ago. Their stock price is down 70%. They're the disruptor. They're at risk of getting disrupted by crypto. So the disruptor is already getting disrupted. And if you look at what blockchain and crypto is offering, it allows for money movement, it allows for lending, allows for savings, allows for investment, allows for asset management. Those create opportunities for disruption for very large industries. And this is why you're seeing very large valuations in crypto, because you're seeing markets converge. The New York Stock Exchange wants to build an NFT marketplace. I don't know if they'll pull it off or not. You're seeing Coinbase get into money transmission. So historically segmented markets are consolidating, and you're having much larger total addressable markets with fierce competition emerging.
So I would argue that the card networks may not be in as much jeopardy as you identify, at least not in the short term, in that there's a number of use cases that crypto today can't be applied to. There are the problem of acceptance at merchant locations. They have a significantly greater footprint at merchant locations. The issue becomes whether the structure of those card networks, which uses interchange from the merchants to benefit consumers with dispute functionality, zero liability, rewards and the like, can be adopted or adapted into the crypto world. I think consumers will feel more comfortable, many consumers will feel more comfortable with that as a way to spend their crypto than through a wallet directly to a company where none of the protections are there for them.
I think it's a journey, and you're right. The usability layer for crypto is horrible. It's very painful to do money transmission with crypto. You both have to be on a MetaMask account, and many people may not even know what that is. It's a leading self-custody wallet. But the usability layer is being solved. Andreessen Horowitz has raised yet another $2 billion fund, and entrepreneurs are attacking that. So it's a multi-year journey. I can tell you, merchants don't like the Visa, MasterCard.
Of course
they will
not.
adopt alternatives. Look at for example, Square, the dongle. Square had a shot at disrupting Visa because they found a way to go to market with the Square dongle. They distributed the Apple Store. Merchants were adopting it until they took money from Visa, which once you do that and you issue on the Visa debit network, then you've got contracts that bind you to the network. So crypto is creating disruption for payments. Look at Stripe. So it's a multi-year journey.
I don't deny that. I don't deny that. I think it's going to be, as you said, they have been building up to prepare, and it will be an interesting battle. We'll see how it all plays out.
I want to throw something into the mix, which is, what's in the mind of regulators. And this is public. This is all over the executive order. This is in public statements from Chairwoman Waters and other members of Congress, which is this idea of financial inclusion. And it's a very controversial topic. Some people say there's no promise of financial inclusion with a stable coin. That's all, politically driven. And then other people and other like stablecoin issuers are actually quite public, and they take efforts to show that there is real promise here. And I think the use case is exactly the one we've been talking about. It's cross-border remittance and making that cheap. And today, honestly, I agree with you, Ram. It is messy and it is not cheap. There are lots of fees that are involved, and I won't get into the math. But to me, it's the winners are going to be the crypto companies and the issuers that really focus on making that a real thing. Because once you can make a concrete financial inclusion argument, once you can make an existing process better, faster, cheaper, immutable, et cetera. And yes, you have risks, right? We can't ignore the risks. But once you can mitigate those risks and make this faster, then I think you will get a lot more potentially regulatory buy-in for whatever it is that that your crypto product is. And so knowing that that is a real important driver for folks on the Hill and for the banking agencies, I would include the Fed in that bucket, including their discussion of a CBDC or potentially, can help kind of think through, like, as an investor, what that might be a question. If I were an investor and I were talking to an innovator, I'd not just want to know who their business team is, but I'd want to know what their strategic focus is around the policy priorities of the administration. Like, that might not be a question they get regularly, but that is a question that down the line they will need to answer, right? So to me, again, it goes back to teaching. You got to know the strategy, the team, the dynamics, who is being disrupted, but you also need to ask the questions that are in the minds of people that have regulatory oversight power. And so, yeah.
I think it's also important to frame things a little bit. So someone asks, for example, what would be the consumer cardholder reason for paying with crypto? I think it's important to understand that there are people who basically live in crypto.
Yeah.
They work in the industry, yep. They earn crypto, they only use fiat because they have to, maybe their landlord requires it, etc. But there's a whole world of people who really don't touch fiat very often. They may touch a stable coin backed by fiat, but they really just don't touch a lot of cash. They earn all their earnings in crypto, they take that and then allocate it across the coins they believe in, and they live really a digital assets lifestyle. So I think it's important to remember from a product development side and from an investment side where I live, that we are not always trying to figure out how to solve problems for ourselves. There are just other people in the world that we understand exist, these crypto natives. We're trying to figure out solutions for them.
But how big are the crypto natives out of 380 million over 18?
Probably not that big now, but you got to remember, I'm going to use the word kids, which I probably shouldn't do. There are kids in their 20s who've been in crypto for half their lives.
Sure. No, I get it.
They will dominate the consumption world in the not too distant future.
But that gives us the curve here that we've been discussing about how long will it take for crypto to be able to challenge Visa and the banks, right?
One proxy is Metamask adoption. So Metamask is the leading non-custodial wallet. There's about 10 million wallets on Metamask. Now I have a couple of wallets in Metamask, so some ratio there. Let's call it 5 million active Metamask holders. By the way, crypto assets, again, I'm saying are 2 to 3 trillion. So what's happened in 2 years? Crypto 10x. So there's a concentrated vocal group of crypto native wealthy. I'm not one of them, by the way. I wish I was. Joined the party a little late. But you're going to see a lot more influence in elections as well. And I love the regulatory stuff, because if you're active in crypto, you have to have lawyers like Alex and others. You got to think like a lawyer to make sure you don't get enforcement actions. But I think the most important voice in regulatory is SEC Chair Gensler. And the reason why is at Cross River and other firms, we're solving for the worst case regulatory scenario. And that is that the vast majority of tokens are deemed securities under the Howie Test, which I personally, and I think many lawyers would agree, including the SEC, that they are. Now, SEC Chair Gensler was previously the chair of the CFTC. Now, there's an interagency working group that's trying to create clarity and standards. Gensler's voice, I believe, will carry the day. He also taught blockchain at MIT, so he knows what he's talking about. He knows the regs. And if these tokens are deemed securities, it will pour a lot of cold water on the industry. It will hurt many actors, including the leading crypto exchanges. It'll stifle the growth and the development. And I would say also this, and this is where I may differ from some of the folks in the panel, is that I think SEC Chair Gensler's view, based on his public statements, is that the laws are very clear. There's something called the Howie Test. You can look at a token, you can measure whether it's a security or not, and they are enforcing the laws. From his perspective, the laws are clear, there's no regulatory uncertainty, and that's extraordinarily challenging, because if you want to offer exchange of crypto and tokens or securities, you need to have a broker-dealer, and the securities must be registered, but none of these securities are registered. So how do you conduct lawful activity in compliance? So this is the major issue with crypto regulation today. What you need is some kind of safe harbor, number one, or a relaxation or elimination of the accredited investor rule, which is depriving wealth creation opportunities, which I'm fully being supportive.
Yeah, and to Ram's point and to the title of this entire panel about evolving crypto, a few days ago, we saw a class action suit where Coinbase is currently being sued on the theory that it's an unregistered securities exchange. And so this is continues to be a very live issue, this whole idea of registered securities. So yeah, I mean, I agree with what Ram said, and it's so critical to stay on top of not just what the SEC is doing, but all the panoply of regulators on crypto.
So, talking of safe harbor, there are multiple banks that have implemented blockchain and their own crypto in a closed loop kind of environment, like JPM, Signature Bank on Signet. And I guess I'll pass this one to Dominic. Do you see that those financial institutions that have an investment arm have a leg up in understanding crypto and where it is safe to be able to make investments and grow the market for their crypto investments?
I think broadly speaking, yeah, that's been a great way for people to learn about the industry. To simply write relatively small checks and see how the innovation takes place. Now, that doesn't necessarily mean it's worked out for them from a rate of return standpoint. It may have worked out for them from a learning standpoint. I'm a full-blown startup person. So you find a problem, you solve the problem, you run into problem solving the problem, you learn, you iterate, and you keep going until you have to stop. If you take that kind of approach in learning from your crypto investments, then you've probably learned a ton. On the other hand, if you're a large financial institution and you've invested in startups, it's crypto, so you've made money, but some of the things that some of the larger financial institutions have gotten themselves into have not necessarily made money. Like, they're not necessarily investing in the broader crypto market. They didn't go out and buy Ethereum, right, or Avalanche or Solana, those kinds of things. They've been basically investing in, can we invest in our own blockchain? Can we, take a piece of open source software, bring our own team in, invest millions of dollars into it, and see if we can develop into something.
Can we use the blockchain within the financial community in the back end of the systems? Yeah.
Right. So that doesn't necessarily provide you with a rate of return, but you certainly learned a lot. So I think the answer is kind of mixed. I think if you invested in a broad range of startups over the last 5 years that touch financial infrastructure, you've both learned a lot and made a lot of money. If you went out and tried to build your own blockchain, you probably learned a lot and you probably lost a little bit of money, but it was probably worth it. And that's typically, by the way, how I see this whole space. Like, I think Alex mentioned the balance between innovation and managing risk. I am from a perspective that you just take the risk. I mentioned this on our previous call. I think the dot-com bubble is a great instructor in there can be pain, there can be loss of money, but the innovation you get to on the other side of the loss. Mm-hmm. These technologies, Web 2 technologies touch every aspect of our life, rightly and wrongly, but they are fully integrated into everything we do. And I think you look at Web 3, and if you really believe in the potential, I think you have to be willing to say, I'm willing to take a pretty meaningful amount of loss at some point for the level of innovation we're going to achieve a few years from now. And I don't necessarily even mean like 20 years from now. I mean like 3 to 5 years from now. So it's not even that far out. And so, I caution people who just want to, put this industry in a bear hug and hold us all in from getting too far out there. I actually think the opposite is true. I'm willing to take my pain for the learnings and for the upside on the other side.
One of the things as I look at the overall environment, and in particular, Mark Andreessen, who I met when he was at Netscape, he starts out developing HTML, which becomes a standard and starts to raise all boats. He creates Netscape, gets in a battle with Microsoft and AOL, sinks AOL, and then gets put out of business as the standard just gets embraced every place as part of the web, web 2.0, and it raises all the boats. Now he's an investor, and he's investing in areas that looks to me a lot like he's trying to create another AOL. It's not a standards-based model that he's targeting. He's trying to pick the best people to build the best company that's going to be able to build a walled garden and help those investors make a lot of money. And I know that's kind of a negative way to look at it. And I know there's a lot of effort to standardize. It's just taking a lot longer. And there seems to be fewer people thinking about standardization and more people thinking about how are we going to get to the next dollar raise for our company by showing the value that we can bring. But then I've just lived through too many bubbles.
Yeah, I think that's part of it. That's just part of the deal. Like, I'm not going to say you're wrong. I just think, part of investing in this way and what will be the future is there's a period where we have a large number of speculators just trying to get rich, who don't really care about innovation. It doesn't matter. They help fuel the fire. They're part of the ecosystem, and they will help drive us forward. And we just kind of have to live with that maybe less savory aspect for the sake of driving innovation.
Ram, so, given all of that, and in terms of merging crypto and fintech, where do you see that going, and how do you think it's going to play out?
Sure. So look, our thesis is that crypto is fintech 3.0. So what is fintech? Fintech, think of fintech lending. Well, DeFi lending is already greater than all of fintech loans outstanding times a multiple. Fintech, you think of payments. So Stripe. Well, Stripe has a crypto business now, and like Visa and MasterCard, they want to make sure they're crypto relevant before they become disrupted by another entrepreneur. So, and as you know, Cross River enables many of the leading fintechs. We're also backed by Andreessen Horowitz too. And I was catching up with our investors the other day, and they said every single fintech wants to be crypto relevant. They don't know how. There's a lot to do to become crypto relevant, which is fine. They need to focus on end user value creation. How do I deliver crypto rewards or buy sell trading capability to the end user, and then rely on a trusted partner that has the compliance technology framework and private key infosec management. So fintech is crypto. These worlds are colliding. It's converging. In fact, I think even using the word fintech now, I feel like it's almost anachronistic. It just feels like 10 years ago. It's that crypto is payments, it's lending, it's stablecoin. 5 to 7 years now, the vast majority of new issue assets will be on chain. We're seeing that now. Fiat has gone on chain. We call it stablecoin. You're seeing Carta competitors that are launching where cap tables are being managed on chain. The next Microsoft will have their cap table on chain. You're seeing commodities go on chain. So that's the future. It's happening for all the convenience benefits and transparency benefits and transaction cost benefits and trustless, permissionless benefits of crypto. So I think crypto, if you're not thinking of crypto as a primary way to organize your offerings, you're missing the boat. Look at what a bank does. Capital markets can issue securities on chain. SocGen's doing this. You can fund on chain. Treasury management, you could source yield on chain. You can have excess liquidity, deploy that on a network like Aave Arc on chain. You can source deposits on chain. Name any function of a bank, and you can find an analogy to that activity on chain.
Yeah. Alex, perhaps DeFi is like one of the major focuses of many of the crypto environments. And I guess the question would be, could you explain it a little bit to the audience and give us a sense of what are some of the popular use cases you see in that environment?
Sure. Well, let's just take stablecoins as an example, right? In the big bucket of crypto. For the most part, stablecoins are used by DeFi enthusiasts, so people who trade crypto. A lot of them are crypto native, to Dominic's point. So in order for them to trade, they need some kind of medium, some way to store value, and they use stablecoins. So a large part, the DeFi community those traders are fueling stablecoins, right? So that's one way to kind of think about it in a very broad sense. What we're going to see, what we've already started seeing, is the stablecoin use case from a retail perspective. So, maybe in 5 years, you go to the supermarket and you're using a stablecoin to pay for your groceries. I don't think you'll be using a CBDC yet, if we have one, but stablecoins are here. And so we're we're kind of at this interesting inflection point where there's a lot of discussion about risk and innovation. And we're seeing use cases migrate over to more of the retail case.
In fact, I kind of wonder whether stablecoins don't displace the concept of central bank digital currencies, in that they're here, they can be tied to the dollar, they can be implemented on the existing banking infrastructure, they maintain the presence of the dollar. A lot of details to be worked out, but it just strikes me it would be less politically difficult to take a stablecoin implementation and bring it to market than a whole new.
You're dealing with a whole different set of issues when you talk about a potential CBDC. I mean, you have to have intermediaries between the Fed, the central bank, and the customer, and those would presumably be banks or even, the Stripes of the world.
Right.
So you're already inserting like another layer when you think about a CBDC, at least as the Fed has been thinking about it. But you're right, stablecoins are here. I think in many respects, one of the biggest challenges with a CBDC is interoperability, right? How do you get these blockchains across the world to talk to each other? If you wanted to, send money, send CBDC to another jurisdiction in another currency, like that is a huge technical challenge. I think the more stablecoins proliferate, the more that they're eventually adopted by retail users, the faster, the cheaper they become. It almost feels like there's a race, and stablecoins have a pretty important head start. So yeah, that's how I would kind of think about them. I think perhaps they will coexist in the far off future. But for now, we got to deal with what's in front of us, and the ways that those could, benefit the broader public.
I suppose that if the US government started to back a stable coin or their own stable coin, the cross-chain connections could be made relatively quickly to anybody who wants to participate, be able to move funds across it.
Yeah, but think about it also from the perspective of the intermediaries, right? It's not clear how much risk they'll have to take on as the kind of the intermediary between the central bank and a retail or a depositor.
Sure.
So they're worried about their own bank deposits on their balance sheet potentially migrating. They're not sure what risks they're going to have to take as a result of this intermediary role. And also the big question mark is how economic is it for an intermediary when it's dollar for dollar, right? And so there are lots of big question marks around CBDCs. Clearly the Fed is focused on it, but I would think from a bank, I'd really want to understand a lot more. And there will be a period for comments due in May on the CBDC paper. So maybe that's an idea for a future follow-up panel.
I think Facebook made big investments in that area and couldn't pull it all together. And so now I guess Silvergate has those assets. Yeah,
Tim, one of the things we're going to do is we're going to need to wind down because we do have the audience with a number of questions that they want.
Wait, we got 7 more minutes. Okay, we'll do it.
I'll be
go ahead,
brief on stablecoins. Just 2 observations. One is you need a bank issue stablecoin in the market. So you have money transmitters issuing stablecoins. They're doing liquidity and maturity transformation, which is a bank activity. And that does create systemic risk now that we have tens of billions outstanding. I think you'll see bank issue stablecoins come. Second, CDBCs, it's not obvious that it's a good policy. I got to develop my view on this, but I'll walk you through the bear case. If you have your assets stored on chain, right, then I don't need my local bank. And what does my local bank do? They use fractional reserve banking. They take my deposit, they go originate a loan. That model goes away if my assets are on a central digital blockchain. The third kind of related point is CDBCs are actually the antithesis of the values of crypto. So you talk to a crypto native person, they can't stand CDBCs. Why? Because the point of crypto is permissionless, trustless systems. I don't have to trust Tim. He doesn't trust me. And crypto solves a double spend problem. We can move money to each other. You can validate my balances. I can validate your balances. I can validate what you hold in your wallet. With a CDBC, you have a central party that could take an enforcement action, let's say, and take my funds or your funds. It's equivalent to like taking cash out of your wallet, right? It's the idea would be
totally with you, Rom. Totally with you. And it would be a mind-boggling thing if our legislature could figure out how to make that all work.
By the way,
American Banker has already come out and go, no.
Right. The leading countries on CDBCs are China and Russia.
Go figure, huh?
Go figure. And by the way, China's banned crypto, and it's created an opportunity for the US to lead on innovation, attract these incredible companies and entrepreneurs, including Ukrainians and Russians, which I think is very noble.
Great.
It's
okay, Wayne.
Also putting out there.
So great.
Just to put a pin on this, we use the word stablecoin a lot in the back half of this call. They are a big part of the industry, but we now have these reserve coins being engineered that are backed by other types of stable coins, not necessarily, or baskets of coins, not necessarily USD backed stable coins. So there are already people in the industry looking to move away from even USD backed stable coins backed by some other basket of crypto, which I think, again,
you're saying baskets of different crypto to be able to stabilize the coin.
Yeah,
exactly. That's
And
been around for a while. Yeah.
They're not stable, but they're starting to proliferate more, backed by like DAI and things like that. And I think for people who
it'll attenuate the risk.
and
not
so I
eliminate.
think for people who don't want to have, and I think there will be and already are a significant number of people in our industry who don't want to have fiat-backed coins in the long run, you'll even see more people migrating to these kinds of coins, which will make, I think, your local bank less and less important.
Take it away, Wayne.
But the mere fact of this interaction is really good, and it really kind of shows with regards to the number of comments that we received as well. So thank you, Tim, for moderating the panel. Really, thank you, Alex and Ram and Dominic, for sharing your thoughts and your insight, and as well as Davis, Wright, and Tremaine for the support for NIPAY ongoing to help make these events possible. So Tim, we do have a little bit of time. There were some questions that came through the chat, and I want to propose these questions to you, and then you can decide who on the panel could answer these questions. Would that be okay? And we just have a few minutes for these questions as well, but we're going to do the breakout. We're going to talk about the next event, and in that breakout,
rapid answers. I got it.
Here we go.
I got it, Wayne. Rapid answers.
Here's a question: how does crypto come into play in the money remittance area? Will it likely dominate the movement of funds in the near future, or will it just be another mechanism for the movement of funds?
I'll take a corner. Rum.
Not in the near future. A lot of usability issues. It's a multi-year process, but you have these transitions that are sharp, furious, and a lot of adoption that could happen quickly. But the infrastructure is proven. It's happening.
Good. Here's another question. Again, I'm raising it to you, Tim. Decide who on the panel. Are crypto companies looking for compliance tools to prepare for the possible regulations, or are they companies not acting proactively? Thought.
Alex.
Yes, they are.
I'd say, okay, so I got the conch here. Mixed bag. The winner crypto companies are hiring what I'll call software as a service providers. The guys that are building the APIs and the stack for things like KYC compliance most recently sanctions compliance. So a lot of stablecoin issuers, a lot of chains are working with these entities. One of them, I'll just put in a good word for TRM Labs. I don't know, you guys might be familiar with them. It's a really fascinating company. I suggest if you're interested, ask them for a demo, they'll do it. And we work with them, so full disclosure there. But I think there are a lot of crypto companies that are thinking strategically and ahead and doing those things.
I'll say that within the financial industry that I spend a lot of time with, they're all thinking about that, and as are the processors, issuing processors, trying to figure out how to make sure it's done safely. Next question, Wayne.
Excellent. Do you think the launch of FedNow will undermine the need for a CBDC?
Oh my God, I love that question. Yeah, wait, we've just spent billions of dollars building FedNow. What, we're gonna do a CBDC and make it useless? Who wants to take it? Nobody? Oh man, I'll take it. So, go ahead.
Go ahead, Tim, go.
No, so I think that's one of the political issues around the CBDC. They've spent significant dollars building a real-time payment network. They're testing it out. They're coming up with pricing around it. They're in competition to say all of a sudden, oh, and there's going to be a CBDC. It's a legislative nightmare. I think that's one of the things that'll jam up a decision pretty tight. Uh-oh, everybody's frozen. Am I the only one moving?
No,
No,
you're
I can see
good.
you. I can
No.
see you.
Oh, good.
Good. Good.
Next
Nope.
wing.
Good. So here's a rather lengthy question, but we want you to hear it in its entirety. It says, my point is blockchain is technology, but tech is in service of business. Having great tech is only of help up to a limit. There is more to business than tech, like customer facing, marketing, pricing, etc. Western Union is not losing any business as far as we can see. And I say this because money transfer is always seen as part of big disruption. But I guess the question that is kind of seeing is how, does this crypto kind of come into play, as far as this is concerned or not? Any thought on that?
I can take that. I would say, a few years ago, the story and the topic was around blockchain, which is the technology. We've moved past that. We've now achieved product market fit, right? That's the venture term when you have a product and you have end user adoption through value creation. Now we're seeing that. I get more yield on DeFi than I get from my Bank of America savings account, where I'm getting 5 basis points. I can move money to my nephew in Northern India for his birthday effortlessly without having to walk into Western Union. I closed my house, I closed a mortgage during COVID. I had to prove who I was to my Bank of America local branch. My signature card was 10 years old. Then I had to schedule an appointment because I showed up and I couldn't access my funds. I don't have to deal with any of that with crypto. I have no cap on the funds I send or the limits or to whom I send it to as well. So it's more than the technology. I take your point of view. I have a very commercially oriented mindset. What's the point of technology for the sake of technology? It has to deliver value, financial inclusion, savings, asset management, investing, convenience. And those use cases have been proven out.
That's
I've got
excellent.
to say, I worry about some of the technology as to whether it's been proven. It's one thing to get a technology into the market. It's another to have studied that technology mathematically through the universities to say, yes, there is no vulnerability to that technology. It's sound and will be good and supportable for 30, 40 years. And I'd use as an example, quantum is arguably now 5 to 10 years away, and quantum can break public-private key pairs.
We've looked at this one, actually, Tim. I'm going to call you out on that one. So SHA-256 is the primary encryption algorithm. It's resilient to quantum computing attack.
Not
In fact,
Bitcoin.
quantum. Let's do a quick fact check on this later. But I know the SHA-256 algorithm, which definitely supports Ethereum and the vast majority of crypto, but Bitcoin can reprogram. It can update itself through the network. That's one of the advantages of this system. So I'm not
better get cracking.
We looked at that risk factor. It was a concern for us, and
it's a non-issue.
Okay, glad to hear it. Next question, Wayne.
And this is the last question. There are more questions, but you know what? We're going to take that in the breakout room. And this question is specific to Ram. Rob, what would be the consumer or cardholder reason for paying with crypto? I see why merchants would want it, but merchants will never tell a customer how to pay.
Right. Well, look at a gas station. Look, it's $4 a gallon. I get 10 cents off if I pay in cash over my credit card. So what you're going to see is a shift from issuer rewards. What are issuer rewards? Chase Ultimate Rewards, Amex membership rewards. All that's rent seeking, right? To use an economics geeky term here. All they're really doing is they're taking money from the merchant, transforming that into reward to drive acquisition and engagement with the consumer. And it's very inefficient. It's better, what will happen is merchants will have merchant rewards. And those are, we have that. It's called coupons and savings. And you see that again in the gas market, and people make decisions on dollars and cents. You'll see shifts in consumer behavior. You'll see targeted promotional offers. Hey, you're in my neighborhood. I can see your phone is in my block. Come in here for lunch. I'll give you 8% off. That's better than my 2% cash back from Costco.
And yet the pump is one of the places where it's hard to use crypto, right? You want to authorize and know the amount before you actually take it and find out how many dollars have been pumped.
Here's another funny irony. So Visa's very into crypto, but you can't use your Visa debit card for a crypto transaction. It gets declined. And guess what? Crypto, you can do that. It's permissionless. It's trustless. So
More to follow.
Yeah.
What's next, Wayne?
Well, you know what? First of all, we really do want to thank the panel again. So Tim,
Me too.
Alex, Ram, Dominic, thank you so much for not only just your insight, sharing this information, and helping to make us smarter in the space. So we want to announce our next event, and that's going to be focusing on the topic of super apps. The question is, will super apps find success in the US? And that target date is April 28th, but keep on checking back to the website, nipay.org, for more information about the next event, and also just for more information about NIPAY in general. Don Lattimore, an SVP analyst with the research company Sloane, he's going to moderate the call, or rather that event. We're going to find out more details just by checking back to the website.
I hope he's going to answer what a super app is.
Yeah, by definition, it can be many different things, huh? I did many different times. One of the aspects of what's coming up next is really the breakout rooms. And so we're going to be, those who stay on, I really encourage you to stay on, because this is a nice aspect of, we're going to take those on the panel, we're going to put them in different rooms, and we're going to break out into maybe 5 or 6 in each room. I don't know if we're going to have time for 2 breakout rooms, but at least 1. And this will allow an opportunity to kind of speak to the panel and also to engage in conversation within the room itself. And so we would definitely urge you to stay on. And that's an opportunity to invite or ask additional questions that you would like to ask, and maybe a little shy or hesitant to kind of ask him in such a big forum. Ron, do you have anything to add before we go in?
Just thank everybody again for doing such a great job on this panel. It was fabulous. I've been seeing a lot of positive comments in the chat feature from everybody. I think we're going to turn it over to Nikki now, who's going to take us into the panel. It's just going to be a random selection of people in each of the panels. We'll get back to you. We're going to do
which unlucky people are going to get me.
And all of the panelists we've asked to be present for this as well. If for some reason you know all the people in the panel, feel free to exit from the panel and go to another one. Okay, so
No.
Nikki, up to you.
Make the magic happen.
I'm breaking out people now. Okay, hold on a minute.
And unmute yourself and put your picture on.